Good morning, everybody. Welcome to the start of a new week, another busy week. I hope you all have a great week ahead. Good morning to Stel and Kay.
Good morning,
Good morning, everybody. Oh, we said that in one voice.
Exactly.
Yeah. Harmony.
You're ready to go.
You have a good weekend?
Yeah, very good, actually. Was away on a long weekend in the Greek mountains, which is
lovely.
nice. It was still 25 degrees Celsius, but it was nice.
Oh, right.
How about you, mate?
Yeah, well, it's been quite warm here, actually. It's been in the 20s, bit rainy, though. So, yeah, a good busy weekend, but a good one nonetheless.
Awesome.
How about you, Kay?
So,
Yeah, a bit shorter than yours.
Is you there?
Guys?
Hello.
My weekend was a bit shorter than yours. Thank you. But all good. Ryan, how does it feel being 50, mate?
Oh, yeah. Wow. Yeah. Happy birthday, bro.
Yeah, thanks, mate. Yeah, quite weird, actually. Quite weird.
Really?
Yeah, I have moments where I think, bloody hell, 50? That's old. Even though I don't feel it. I still look 35, so that's the main thing.
Yeah, exactly.
Life begins at 50, mate, I tell you.
Yeah.
Yep.
What, the end of life, or like, is that the best before date?
Yeah.
Yeah, no, very weird, but yeah, I don't feel that much different, to be honest. But we had a good party anyway this weekend, heavy one. So yeah, all good.
Ooh.
So let's crack into it, because we do have a busy week ahead. Obviously, I was off Friday, so thanks to Kay for stepping in, taking over. I'm sure he kept you well in the loop of what was going on. There's not been huge amounts of headlines out this weekend. None that I've seen that's really noteworthy. It's really been about the sentiment and the data. We had a set of soft China PMIs out. Further lockdowns happening over there. Disneyland, Shanghai shut down, other areas shut down. Foxconn shutting down part of the factories over there. So really, we're seeing that sort of lockdown stuff picking up again in China. Twin it with all the soft data as just mentioned, and here we've got dollar yuan, pushing all the way back up into the 730s again. Now that comes as last week I saw a comment from I think it was the Chinese banking and insurance regulator. I assume you called it, Kay, that people who sell the yuan will regret it. But it's not having much of a difference, is it? Was there any further rhetoric out from those guys Friday over the weekend?
No, not that I've seen really. Apart from that, the rest is PBOC fixing a bit higher, injecting some cash again, weak PMIs. It's there have been some other reports also saying that Chinese data are not yet ready to turn a corner. So the sentiment in the market towards the Chinese yuan is quite negative.
Yeah, indeed. And let's see if I've got that data here. Where are we? Sunday. So there we can see the PMIs. These are the other PMIs. I think these are the official ones rather than the private ones that we get. So pretty much mirroring what we saw last week as well. We're going into contraction there, but still, as Kay said, there's no real sense that anything's going to be happening there, turning the corner, getting back to growth. I suppose we've probably got to keep an eye out for any possible rate changes. Still got the threat of the reserve requirement ratio cut, which is one of the big ones there. Maybe if this data continues on that current trend, we start to see those rumours circulating. So if you suddenly see a pop in something like Aussie dollar, then have a quick look around the headlines, because it could be that we've seen an RRR cut. That's the sort of thing that usually happens on one of those cuts. Japanese data as well out over or late on Friday, early this morning. Retail sales came out not too bad. on the whole, not too bad. But what we saw was consumer confidence just slipping back a little bit. As you can see there, 29.9. So retail sales were a little bit better. As you can see, large retail sales particularly. Not as high as last month, but still coming in positive number, year-on-year positive number. Industrial production, again, a little bit softer than expected, or rather than prior. 1 month ahead a bit softer. So little bits and pieces of some of the data we're seeing that are down, but others are looking higher. And we got that Tokyo CPI last week too, so still showing strength on the inflation front there. But not that any of that matters to the Bank of Japan, because they're ploughing on ahead, as we saw last week. On the ECB side, we had ECB's not out over the weekend. He's a fairly hawkish member. He's saying that 50 or 75s are on the table as far as the December meeting goes, and that we're not even at half time yet in fighting inflation. A little bit of a football reference there. And that's been pretty much the picture we've seen in Europe. Again, coming from Friday today, inflation is hot in the Eurozone. Germany was up, Italy was up. The only country really dipping back last week was Spain, seemed to be bucking the trend. Saw German retail sales down this morning. So some of the data is turning, other data's not turning. So what they want to fight, inflation, is still remaining strong in the Eurozone. And indeed, we got the Eurozone flash numbers this morning, beating expectations, 10.7% on the headline number versus 10.2 prior, 10.2 expected and 9.9 prior, and that all-important core number beating expectations, coming in at 5% versus 4.8% expected and prior. So that should keep the ECB needle on to hikes. Maybe we're setting up for a bit more of a higher ceiling to come from the ECB. We've had this constant, when are they going to slow down, or they expected to go 75s and then scale down already and take the slowly approach. This may be forcing them into maybe a bit of a faster approach. But we're going to hear what they want to do for December from every ECB member, probably 8 times over. In the meantime, in Germany as well, one of the big trade unions, IG Metall, is calling for warning strikes over there. Obviously, cost of living crisis is hitting there as well as everywhere. So getting wages up is a big thing there. The German unions and trade associations are very big over there in terms of pushing for wage increases. That, I think, is all going to probably kick off again in the new year as they get set to issue their pay rises. So that could be something that we need to watch into the new year. Looking at some of the other data, going back to Friday stuff, we had the final Michigan reading, which was a few pips better all round. Pending home sales were down 10.2%, down 30.4% year on year. So again, another housing metric not looking too hot. But overall, I mean, guys, you can step in on this one. Just coming back, not being here Friday and coming back and doing a bit of catch up, it just looks like we've had a bit of another pendulum swing from people trying to play the Fed pivot or the soft data at the beginning of the last week in the US, bringing down rate expectations, and it seems we come into Monday and that's all switched around again, and everyone's looking at how quickly the Fed might get to their 5% ceiling, if not more. Pretty much well reflected as we've been watching in the 2 years then. Gone from 4.2s up to 4.5s again. Has that been the case? We've had another switch around?
It feels like it. I mean, at the end of the day, I don't think the market knows what's going to happen. The market's hoping that there's going to be a kind of a turnaround, or at least a start of a turnaround. But really, the fear is that Powell is just going to keep going, and I think that's the most likely scenario. So I think the market wants to hope that there's going to be a turnaround, but it's realizing that the chances are that it's not going to come. That's what I think is happening. But at the end of the day, it's just trading like a headless chicken. One day it's 2-year yields are up 10 basis points, the other day they're down 10 basis points, and it's like who knows? That's the thing.
Yeah.
But for me, unless Powell tells us something different this time, for me nothing has changed. So
yeah.
Are we? And a friend is asking, are we waiting till FOMC before taking any positions in the dollar? Yes, I am not doing anything before.
Yeah, I think it's just another situation we spoke about last week, with everyone looking on the, let's call it the pivot side after the bad data. We have to know where the picture is when we go into the meeting. If not for the long term, but at least just for this week, for Wednesday, when we get the FOMC. Because that sentiment going in gives you your price risk. That's all I'm looking for. Right now, I don't care what the Fed says at the time. I want to know the risk going into the event. And the risk last week was that we maybe get too extreme on the dovish side going in. Therefore, if Powell isn't as dovish as the market expects, we know what the reaction is going to be. Now we're potentially getting back to a hawkish slant, which then brings potentially the bigger risk of, if Powell says something not as hawkish as the market expects, then we get a reaction, dollar sold, yields off. So for me, these moves, while Stella says it's a bit headless chicken, it is important to know where we're at in the short term going into the meeting, because then that gives you where the biggest price risk is for the event itself. Kay, what do you make of it?
I think the market is just in a yo-yo until the FOMC. I've said on Friday on Face, I think we are going to go around these levels into the FOMC. Terminal rates, the 2-year is going to be the closest one to the Fed funds. We are anywhere between 4.5 and 5, so why not go into the FOMC around 4.5 in the 2 years? And the 10s the thing that happened in the 10s was like the leading indicators coming down. So beyond Fed hikes, the market is looking for an economic slowdown, and that explains the 10s. And I think we're going into the FOMC with the 10-year around this 4%, and then we see if Powell keeps the foot on the pedal for longer. Yeah, these things should go back gradually around 4.25, 4.5 perhaps. I don't see them come off too much lower for the time being, unless we get a string of negative data. So, as you were saying at the beginning of the show, the week is going to be extremely important, because we have the labor report at the end of the week, which has the potential to, if it's again people looking for a pivot, if it's weak, then I think we're going to see the US rates market on the move for real.
Yeah, definitely, and it's coming straight after the Fed as well. If we do get a fairly hawkish Fed, or at least they're saying we're not going to pivot, we're staying on our path, and then we get a really crap NFP, it's really going to set the cat amongst the pigeons, and the pivoters will be out again. But that's how we trade it. We look at that and say, right, well, are they right or are they wrong to start trading the pivot again? And that's given us enough volatility and two-way action to get a trade in. But yeah, we do have another big week of data, and you can see that from the calendar there. We're getting the big ISMs from the US this week, the final PMIs from around Europe. Tomorrow or this evening, we've got the RBA coming out, first of the central bank runs this week. FOMC starts, which obviously then comes out on Wednesday. Getting some the ADP as well on Wednesday. Now, just looking at the NFP quickly, expectations are around the 200K mark for the NFP, and that ADP, which is the newly modeled ADP, they've changed all their calculations around because they basically couldn't hit a cow's ass with a banjo with their forecast previously. So ADP is expecting 190K out on Wednesday. So that's one to keep an eye on, because the market always looks at that as a bit of a reflection for the week, or for the NFP. It's not on that calendar that I can see, but we also get a report called the Challenger Gray and Christmas layoffs report, which I believe will be on Wednesday as well. Unless, oh no, there it is on Thursday. So the Challenger job cut report there. This is a report, it's only a small report, but it highlights firms' intentions to lay off workers. So if you hear a headline that, I don't know, Tesla are going to cut 30,000 jobs, this is the number where it ends up in. So it is a good number to keep an eye on, just to note if there are any big intentions to cut workers, and it breaks down into the sectors and indeed any firms itself. So it's been doing all right as of late. There's not been that many cuts, but if we start to see some big numbers coming in, 30s, 40, 50,000s on the month, that is another little signal to watch out for, that we're going to start getting problems in the jobs market. Think of it a bit like the NBA housing report. It's a small number, but it can give you a little bit of a signal into when the jobs market's going to change. So after the FOMC on Wednesday, we then have the BOE on Thursday. There's been a little bit of a can kick there, if you may recall, because we were supposed to be getting the fiscal report today, but that's been booted to the autumn statement, 17th of November, I think that is. So that may be a little bit different in terms of expectations. I'm not too sure what to make of it. I don't know what hike we're going to get, whether it's going to be a 50, a 75, or 100. I'm really out in the forest on this one. You guys got any thoughts what we could get from the BOE this week?
It is really a flip the coin, because we could say if there's austerity and the government needs to borrow less, it would be okay to hike more. But as opposed to when Truss and well, I forgot his name, just Kwarteng through the kitchen sink at it, it would have been putting pressure on the Bank of England for not to raise too much. But then it's anywhere between 50 and 100, and I'm going to say 75 and stay in the middle. But I mean, it's really it's strange, because the market wants to price a very high one, but then commentators, like economic commentators, say that it would be a bit foolish to do 100 now, ahead of the budget. So it's really a flip the coin, this one, for me.
Yeah, I think I'm pretty much the same on the 75 fence, because inflation, we're still in 10% inflation, and that is still a big factor, obviously, of BOE policy. Sorry, Stel, were you coming in on that?
No, I was just going to say I really don't see them. I don't see any reason for them to do more than 75. And given that this is what the Fed's been doing, how central banks like to toe the line, and I think they're going to do 75. The fact that Rishi Sunak is now PM is definitely good, because, I mean, market-wise, it's good. And let's not forget, like you guys said, inflation is still 10%. And wage growth is also high, so it's not like we have 10% inflation and wages are stagnant. It's it's all going higher, so they have to act. Will they do 100? Of course they can, but I don't see why they should disturb what market's expecting. And I haven't looked at Sonia's recently, but I think we're pricing 75. So yeah, I think 75, and we see how it goes. That's what's going to happen, I think.
Yeah, definitely. Let me have a quick look at the rate odds and let's see what's currently being predicted. Yeah, we're mainly pricing a 75 and a 50 at the moment. 75 is probability of 97%. 50 hike is obviously the balance 3%. So as far as the models are going, we're not pricing 75 or 100. We're pricing 75s or 50s, but that can flip around pretty quickly on those metrics. Just finally to add on the data front, it is a double bubble with the Canada jobs report as well. So if you're trading the loonie, you need to keep an eye on that one, because it can be a double wind with the NFP, or it can be an opposing force. So that one needs to be watched as well on Friday. So I think we'll just running into the price as well. You guys got any other headlines or bits and bobs you want to add to the story before we get into the prices?
Not me, apart from Elon Musk buying Twitter and already pushing conspiracy theories. That's interesting. Did you see that? Oh my God.
Yeah.
We have
And
to find
charge
another
it.
platform now, I think.
Yeah.
You guys,
Have you got blue tick?
have you guys seen that apparently Trump came online for 30 seconds or a minute or so? Or I don't know if it was a fake or a real one, but that was funny.
Yeah.
No real other headlines apart from the fact, and Mike just reminded us about that there's issues going on at the Foxconn factory,
Yeah.
which is the one of Apple's supplier, and they are hit by the COVID lockdown. People literally fleeing the premises. So that's another one weighing on Chinese yuan for the time being. No, for the rest, morning headline, Norges Bank is going to sell 3.7 billion Norwegian kroner every day. That's in the month of November. That's a little bit less than prior month, but still, they are still buying FX and selling Norwegian kroner, which reduces a bit the flows that may be seen for tax purposes that Norwegian exporters, energy exporters need to buy Norwegian kroner. But I think I'm still of the opinion that sooner or later Norwegian kroner may receive a little bit of a knock on the head due to that. But fact is that Norwegian kroner is more doing the yo-yo than anything else, and actually strengthened quite a bit over the past couple of weeks. But I think it's maybe only temporary. Just having to say that I'm going to have to jump in a few minutes, Ryan, as I told you.
Yeah. No worries.
Yeah, the one thing that I wanted to say today is that we are in end of month. This is the last day of the month, and we've seen already stuff happening. We've seen it on Friday, if you recall, after the Bank of Japan, and then this morning as well in Tokyo, and now we are seeing it again. The yen is again under pretty severe pressure. Keep in mind what Bank of Japan Kuroda has been saying a couple of times, that 200 to 300 points moves over one or a couple of sessions are excessive. So if we would see more yen selling, be careful, because the low, the post Bank of Japan low, we quickly hit a 146, and we are now trading above 148.5, which is a 260 pips above that level. Even if you look at the level where we went into the Bank of Japan, if you recall, it was around 146.40. We are also already more than 200 pips higher. So never say never, okay? Even if they put already a lot of energy in the interventions, be careful what's happening on the yen this afternoon. Could be, I don't know, around fixing time or just after the fixing. Money never sleeps, so be careful what's going to happen over there. And for the rest, really, I'm in jobbing mode right now until the end of the month, and even into the FOMC. I've got very little. I feel very little incentive to go heavily one side or the other for longer than the actual move that is happening at the time. And on that note, I'm going to wish everybody a fruitful and safe day today. Talk to you later on Face or tomorrow.
Before you go,
yeah.
Just before you go, mate, there's a quick question from Horatio in the Q&A. He says, with Mexico the #1 exporter of silver, does the price of silver have any effect on the MEX? Is there a strong correlation there?
Well, there is some sort of correlation, but then it's, as Stelios already mentioned as well, there's a discrepancy between where the paper price trades and what the real demand is in the market. And so to trade what's going on in the spot in the spot market, the spot FX market, silver is coming off, but Mexican peso is very, very little impacted by it right now. And I guess that has to do with what Stelios was already mentioning, that that the physical is still very much in demand, and reserves are not really very high. So I wouldn't trade mix on the back of silver myself right now. Let's put it that way.
I agree with that. And you know, this discrepancy between futures price and physical has always been there, always, but it's been relatively small. So now when this discrepancy becomes almost 100%, so that's when it becomes interesting, because somebody can actually do something about it. When it's small, I guess it's complicated to, you know, take futures to expiry, take delivery, blah, 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 you know, why bother? But now it probably kind of makes sense. Anyway, yeah.
You go, Kay. Yeah, you head off, Kay, and we can catch them up.
Thank you, Kay.
Yeah, cheers,
mate. Right, so I mean, I'm pretty much in the same boat as Kay. I'm not looking to do too much unless there's a bit of sniping opportunity here or thereabouts. It's all about setting up for what's going into the Fed and everything. Managing positions. Now, I am looking closely at the Aussie dollar, obviously because I'm long, and we just seem to be failing at the moment in this the 64 handle. Looks like it's 64.00 to sort of 63.90. We also got the strong move up last week. A lot of that to do with the bad US data, the pivot talk and all that sort of stuff. We ran right into a big zone up in the 65s, this zone here that's 65, 20, 40, call it. Slammed into that. Then we just notched down through the minor levels. 64.50 was an area that we did try holding when we broke above. Then we failed. Then we had some more minor levels, but this 64 level is the one that we've been watching for quite a few weeks to see if we're going to break it. We had several attempts, couldn't get above there. Well, that was a real number to get above. A couple of attempts there. Then we got the break, held it. Sort of about this 63, 70s, 80s. Then we got above the 64, started to hold it, but it looks like it might be going. If we do, this sort of 63, 70 is going to be a bit of a line in the sand. Get down there, we get back down to 63, 40, 50 area again, which was another strong resistance point all the way through. So really still, if you look at a wider basis, still going sideways. 62, 65s is looking to be the range, and while we mess around in the middle. With the RBA tomorrow, are they going to turn really more hawkish than they are? We already know that they scaled down hikes, but then we saw some hot inflation numbers. Could they ramp them back up again? Or at least signal they're going to stay on the same hike increments, but maybe go for longer? Again, what we're going to see probably from the Aussie dollar is that it still doesn't really matter. It's whatever the Fed is going to do that matters, because here we have yet another central bank hiking away, and while they were hiking, Aussie dollar was making, you know, lower lows all the way through. But we have had this semblance of support now building here, where it stopped going lower, and as long as we're holding this area down here into the 62s, then we potentially can build on this support area and push higher. But unless we get above this 65 level, just another small step in the run that we've seen, I think we're going to stay in this range here. And it's a similar situation for euro dollar as well. You know, we had the break up, we had the move up. We actually ran into the 100 DMA, as you can see there. That marked the top last week, and we're slowly slipping back down into range. Now, I need to point out that there are some big expiries off this week around parity in the euro dollar, and quite a big amount. There's over 9 billion rolling off throughout the week this week, and that's big because I've not seen it over about 4 or 5 billion for any particular strike for quite some time. So to have around 9 billion going off throughout the week, different days, that could be quite significant if we see the price gyrating around that parity mark. If we move up there, we could get a bit of action going on depending on how the market's playing it. There is a big one today, over 2 billion is expiring up there today. Obviously we're 60, 70 odd pips away, but you never know what may happen later. But overall, you know, the price action, again, we had this stability, finding a bit of a bottom. Then we started seeing a series of higher lows, but we're not getting the breaks up. And, you know, when I look at moves like this, I look at where can the trend change. You know, the 38.2 fib of this whole move going back to 2021, this whole trend is still up at the high 105. So, you know, we're not even close to that. So this is keeping the downtrend firmly in place. But I'm not expecting it to perhaps go all the way back down to the lows unless the Fed turn really hawkish. But I think we're going to see a bit further period of consolidation. We're going to be going sideways. Probably 97 to 96 is the big figures down there are probably your limits for the downside range. And we know we're finding trouble into the parity numbers there. Can't get up to the 101s at all. So these highs are now marking themselves off. You know, also around here we've had some former support areas into just below that 111. So that's sort of your area, sort of 100 or parity 75s, 80s up to the 101s. That's maybe where we find a top, and then we stay in this range 96, 97 up to 101. What are you making of it still? Just generally not really showing any signs of changing direction either way, is it?
No, not really. And I will say what I've been saying for days, actually, no, probably 10 days now. Remember, we're talking about the run up to this Fed meeting this week. And, you know, I was saying, I think on the S&P, for example, 3,900 was a pretty not easy, but I think it was doable. And look, it was done. 4,100 is the next level. I don't think we're going to get to, because the market's a bit too skittish, you know, too scared of what Powell might do. You know, we've reached that. And, you know, in terms of the euro dollar, like you said, you know, we can see where the top side is. It's been pretty clear, obviously, unless Fed changes his view in a big way, you know, it comes out dovish. I don't think we're gonna be able to breach that, you know, 101 or whatever that was up there, 10007 or whatever that was, yeah. But I still think that Powell will disappoint the bulls. You know, I mean, there's been reason for Powell to change his tune a little bit, but I think what they're probably looking at is the markets, and the markets are not panicking yet. You know, yes, we're down 1,000 points from the highs in the S&P or close to, but we're still well above pre-COVID highs. And, you know, they've been tightening and they've been rolling off the balance sheet and doing 75s at a time. And the market has been surprisingly resilient. You know, I would have said, if you had told me before, you know, they would have hiked, you know, to 4%, whatever they're going to be now. Actually, where is rate? It's going to be to 4%, isn't it?
Yes, we're with 3.25.
Yeah, 3.25. So it's going to be 3.75 to 4. You know, if you had told me this a few months ago, I would have said, man, you know, the S&P would have been at 2,500, or, you know, it would have been below pre-COVID highs. And I have to admit, it's been trading well. So I would be very cautious. If I was long risk, I'd be very cautious going into this meeting, because I think the most likely scenario is he disappoints. And if he does disappoint, I think the reaction is going to be pretty powerful. We're going to see yields take off take out the highs. 10-year could easily take out the 430, whatever it was the high. I can't remember, 420 something. And stocks, I think, are going to head towards 3,300. And 3,300 is the level where I've been saying for months. I think that's the level where the Fed is going to be turning, and I think that's going to coincide with early months of 2023 when we do start to see inflation dropping. So that's my view, has not changed. You know, I still think the same. I still really, really want to get very, very long metals and other risk assets, but I'm not doing it yet because I don't think we're done.
No, I agree, and I think we're still, for the longer term, we're still trading not so much the increments, but where the ceiling is.
Correct. Yeah.
We don't get any predictions. Projection, sorry, until the December meeting. That'll be the next projections we get, or is it even January? I think when we got them in September, didn't we? Yeah, so when it gets in December, and those will be that will be the important meeting, because we need to be watching the dot plot. If we see their terminal rate, their ceiling lifting higher through 5%, that's going to bring us the next round of hawkishness and the next repricing in yields higher. Dollar obviously following suit, and that's when we need to watch your pairs like your euro dollar, dollar yen, all those Aussie dollar, all those lows that we've got in place, that we've held since September, and the Fed made that 5% ceiling. If we get another change to the ceiling, it's higher, you're going to need to watch down here. If we get that and we don't break these lows, that's really going to cement the bottom, and if that's the case, that's where I'm going to be looking to buy it on that price action. So really important, not so much the increments, but whether that Fed rate ceiling gets lifted up at all.
Yeah, I can't argue with that.
Yeah, cheers, mate. Just going to look at a couple of pairs really, and then we'll let you boys and girls go. Euro sterling still all over the place really for me, at least in the short term. There's no real clear fundamental drivers here at the moment. It's all about what's going on in the pound, with a smattering of what's going on in Europe. So a bit undecided for me. I still favour playing it for the long side, but only if we get a move down, maybe down to the 83s, somewhere like that. But if I do get a signal that we are going to see some strength, particularly from the Eurozone, then I will want to be playing this from the long side. Still got this bit of a zone going on here, 86, 45s to 70s. You know, as you can see there, from a technical standpoint, it holds. It doesn't hold, it breaks, then it holds as resistance. So these are the sort of areas you need to keep an eye on. If you're playing this, if you get up there and you can't get through it and you're long, then you need to ask the question, what do? Do you take some money off the table, get a break above, then potentially you're sailing high? I don't know. I may have a little go down in the 85s if see what the Bank of England brings, because that's the next zone to look at. Big figure if we test down there. We haven't been down there for a while. That may be one area, but it'll be a reaction to whatever the Bank of England do. Some of the other pairs just to look at quickly. Dollar CAD, say we've got the jobs report coming up on Friday. It's been making a real strong case around this 135 handle, and that's looking pretty strong. It's getting to the point where I may look to try a break short. I like a level that's tested quite often, but with a decent amount of time in between, and where it looks really solid. Long still may be worth attempting against this level, but every time we do test it in quick succession, you've got to think of reducing your risk if you're trying longs there. But otherwise, potentially setting up for a possible break. If you do get a break, it could be down at 134 pretty quickly, maybe even to that 50 fib there. But with the jobs report going on, that's one to keep an eye on. Make an assessment after you've added that and the NFP together. I just want to quickly add for you folks, because there's been a bit of confusion today over the timing of the flow show. It's at 10:30 UK time. Okay, whether that's in the summertime, it'll be 10:30 BST. In the winter time, BST moves back, as it did this weekend, to GMT. So before it was 9:30 GMT, 10:30 BST. Now GMT and BST is effectively the same time. So 10:30 is the flow show time, UK time. That's until March, obviously, when we hit the summer clock change, and we go again. What that is in all your different time zones, I'll leave you to calculate that. But obviously the US, I'm not sure how long before the US changes it. Is it 2 weeks?
2 weeks usually, yeah.
It's usually 2 weeks.
Also, just want to note, we are changing as we speak the banner on the site to say to change from 9:30 GMT to 10:30 UK. So it's always 10:30 UK time.
Yeah, we changed the banner on the tweets and stuff, didn't we, back in September? So that was all right. We just
we forgot the site. Yeah, I blame Steve.
Yeah, blame Steve because he's not here. So yeah, we can blame him as much as we like, mate. So yeah, you've got that little time difference between when the US clocks change. So for those of you in the UK, the data for the next couple of weeks is an hour earlier than it was previously, and then obviously the US clocks will catch up with that. But as far as the flow show goes, it's always 10:30 London time, UK time, be that BST or GMT. Hope that clears that up. Still, you got anything you want to add?
No, I just want to say once more. I just want to say once more. I've been saying it a lot, I know, and I sound repetitive and boring, but there's no reason to try and be a hero. You know, I see comments, people saying, "Oh, I don't know what to do with this market. I'm scared of this market." That's good. That's okay. You know, you can, when I don't understand something, I don't touch it. So it's okay to not take risk when the risk reward is not good. And frankly, if you're taking a position over the Fed, you are betting on what they're going to do. So if you have a view, you know something, good for you. If you don't, then you're betting. So just be sure, be aware of the risk you're taking. That's all I'm saying. So I just want to reiterate once more, no point trying to be a hero, catching bottoms or tops, because you're going to get burned 90% of the time.
Yeah, exactly.
That's all.
And if you've got a view on the Fed and it's basically, I think, then yeah, you are taking a gamble. If you've got longer term positions, then you know you're probably not going to be affected by the news. But you know, keep an eye on it, keep and manage it. If you suddenly see yourself with a decent amount of profit, you can always take some off and reload after the event. But yeah, so this week is a good exercise in scouring your charts, picking your levels, knowing where we are into each of these risk events. And then so you know how to react to them afterwards or over the events.
And one more thing, the stuff I say, it comes from experience. I've been burnt so many times. So you know, it's not that we're born knowing everything. Of course we don't know everything and we make mistakes all the time, but when you make a mistake 2 or 3 times, you kind of learn from it. And that's what we're trying to what we're trying to give to you people, you know, to everybody who's watching this show, that, you know, this stuff that we know from our experience. That's all. We could be right, we could be wrong, but you know, when you have some experience, you kind of have a little bit of an edge, just a little bit.
Yeah, exactly. And you know, we've been doing this flow show for several months now, so we've come through ECB meetings, Fed meetings, all the central bank meetings. So if you've been watching us from the start, you should have a good idea now how to trade and set up and plan for these sort of events. So nothing should be new for you. And yeah, that's what we do each and every month, because it's always the same thing we have to do: plan.
Exactly.
So anyway, on that note, Mike's saying DST will end in the USA on November the 6th.
1 week then. One week then. Okay.
Yeah, thanks for that, Mike. Yeah. Anyway, have a great day. Have a great week, folks. We look forward to seeing you again tomorrow. And yeah, let's wrap it up and go grab those pips.
Thank you, Ryan. Thanks for being here, Ryan, day in, day out. Thank you. Thanks, everybody.
Thanks a lot, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.